Hi and welcome to this week's Property Insider video. Today Dr. Andrew Wilson is going to share his forecast for property prices in Australia, where property values are going to be for houses and units around Australia at the end of the year. We're also going to have a bit of a talk about why some of the forecasts made earlier this year didn't come to fruition. We'll discuss the Reserve Bank's latest minutes, explaining some of their thoughts on what's going on. And of course, as every week, Dr. Wilson's going to share the property data from around Australia. If you'd like to keep up to date with the latest property headlines, why not subscribe to this YouTube channel and click the little bell icon so YouTube informs you when we bring out our show each week. The media seems to love bad news more than it loves good news. All over Australia, we're bombarded with bad news, and nowhere is there more unpleasant news than in my hometown of Melbourne. But when we look at many of those bad news stories, the predictions made earlier this year by some high-profile economists, as well as the usual tribe of property naysayers, those ones attempting to exploit a pandemic with some publicity, we're finding that they're consistently wrong. Back in March, when the pandemic first struck, economists were lining up to forecast real estate prices would collapse. There were predictions of 20 to 30% property falls from some of the usual suspects. And when the property data came out in April and May, they rationalised the strong results, saying, it's only early days, just wait and see. But now we're 6 months into the pandemic and we've seen property data for May, for June, for July, for August, and there seems to be no crash. So the experts are starting to backtrack, and they're significantly changing their forecasts when our property markets didn't fit neatly into their theories about how they should behave. Well, over the last week, we've had the Australian Bureau of Statistics figures on the housing market, plus the Reserve Bank's most recent statement. So to discuss these, as well as give us an update on all the latest market data, I'm looking forward to my weekly chat with Dr. Andrew Wilson, Chief Economist of My Housing Market and Australia's leading housing economist. Welcome, Andrew.
G'day, Michael. Yes, I enjoyed your introduction then.
It's interesting to look back and see. I know it was early days and people had no real idea of what's ahead. In some ways, the pandemic has been worse than many predicted, but the results on the property market haven't been as bad as they did predict.
Well, that's true, Michael, and also our economy is performing perhaps a little better as well. But look, we have hard yards to go in terms of the economic outlook, particularly given what's been happening in Victoria. And on the plus side to that, at least there looks to be a light at the end of the tunnel in Victoria in terms of the health issues. So fingers crossed that economy can start to recover as the rest of Australia seems to be recovering at the moment.
Well, in a moment, we're going to have a look at the Australian Bureau of Statistics property data, even though it's a little bit backward looking, and at the more recent Reserve Bank monetary statement. So we'll have an understanding of what they're thinking. But let's start with what's happened to our property markets over the last week, Andrew.
Well, Michael, second week of the spring selling season, auction activity has remained reasonably predictable. Sydney continues to track clearance rates at around about that 70% mark, which is a pretty good result for sellers. 7 out of 10 properties selling under the hammer. Other markets, other capital city markets also not doing too badly. Adelaide and Canberra have also continued to record clearance rates 70% plus. Of course, we must mention the Melbourne market, where the shutdown of auction activity is certainly having an impact on results. Just 10 auctions reported listed on last Saturday, Michael. That's very low compared to nearly 800 the year before, but no surprise. It's really no use discussing clearance rates with only a handful of auctions there. If we look at the data in terms of just looking at passed in plus sales with a basic clearance rate, putting withdrawals to one side, we can see that there are reasonable amounts of sales compared to the total number of properties reported as being passed in or sold. If we look at our other data, firstly, new listings continue to be reasonably steady at this time of the year. National new listings, Michael, around about 80% of where they were prior to the coronavirus at the beginning of March. However, the real story is when we look at the comparisons with the last year at the same time, we can see that steadily now declining. New listings are tracking around about 13% lower than at the same time last year. And what that does tell us is that the spring selling season hasn't got the same drive as it did last year, which was also a revival in the cycle. If we remember correctly, sellers started to become more confident a year ago in the marketplace. And of course, a lot of that is lower listings in Melbourne. And if we look at the capital city comparisons, we can see that Sydney is well ahead now. If we base Sydney at 100, Melbourne is really around about 20% of new listings at the moment compared to Sydney. Newly reported sales, Michael, again, are looking quite healthy for Sydney and Brisbane. Brisbane particularly is moving ahead quite strongly in terms of newly reported sales. No surprise, of course, that Melbourne is going the other way. And when we look at the relative position of capital cities in terms of the volume of new sales over the past week, we can see again that Melbourne has around about 20% of the new sales reported over the last week compared to Sydney.
Yeah, with the markets moving so quickly, the data that we used to rely on is not as relevant. We really need in-time data, and that's why I appreciate you giving us these updates every week. But also over the last week, the Australian Bureau of Statistics brought out its most recent house price data, and it is going back a couple of months, but it again shows how the forecasters got it wrong.
Yes, Michael. Well, ABS released their June quarter house price data. Of course, these are for established units and established houses. We can see that the results were in line with other data providers which released their product some months ago. So we do sort of know generally what the results were going to be. Perhaps the one surprise there is that Sydney houses declined a little bit more than others had modelled. But again, that might reflect the fact that these are established properties the ABS is reporting. But I think that when we look at the annual data, Michael, that's quite revealing for both units and houses. We can still see, despite that fall in Melbourne and Sydney, particularly over the June quarter, that annual prices were still quite high, nearly 10% in both Melbourne and Sydney for houses, and quite strong for units as well. And of course, that gets back to your introduction, whereby I guess the usual suspects and those that maybe don't do as much homework as they should in terms of the historical evidence predicted very sharp declines in prices growth last year. We remember the market really was in, I guess, a lather of fear, both buyers and sellers through late 2018, early 2019. But the reality was that then predictions of 20 to 30 to even 40% falls in house prices in 2019 were completely wrong. And in fact, we had a very strong period of growth in Melbourne and Sydney. And we know that we've had, as you said, similar predictions for this year as a result of the coronavirus shutdown. Well, I'm not predicting that we will see the same sort of growth that we had last year, which was driven not just by that catch-up energy in the market in Melbourne and Sydney, but also those 3 cuts to interest rates gave the markets the capacity to grow. But I certainly think that this year, and I've produced some forecasts just to show that I'm prepared to put my skin in the game as well. I've produced some forecasts where I believe the markets will fall at the end of this year. And I think most markets in terms of house prices, particularly the smaller markets, will be above the line, only by a couple of percent. And that's the new reality. We don't have lower interest rates to push up house prices as we have in the past. So I think that most house prices in most capitals will remain above the line, the exception being Perth, where prices, I believe, will be flat over the year. And Sydney, I think, will just be below the line in terms of prices growth. Well, I think there's certainly potential for that Sydney market to record higher prices over the year. So I think the risks to the Sydney market are on the upside in terms of growth. However, of course, Melbourne, I'm predicting around about a 5% fall over the year. And I think because we are certainly still in unknown territory in the Melbourne market, with the shutdown still not having been concluded, that the risks are to the downside in that particular forecast of 5%. For units, similar results for units, Michael. I think that the smaller markets will do better in terms of unit growth this year and above the line, and just the Melbourne market and the Darwin market and Perth being below the line in terms of price outcomes this year. Now, I don't think I'm going to be too far away, Michael, so maybe we can wait and see how it all pans out at the appropriate time.
I think the other point to make, as we often do, is that we shouldn't just talk about the Melbourne property market or the Melbourne housing market, because there are the inner suburbs, the middle ring suburbs, the outer suburbs. Even with the apartments, there's the new ones and the established ones. So this is an overall picture. And within markets, if you're looking to buy a home, looking to sell your home, looking to invest, you've got to take a much more granular view. But it's important to understand the moods of the market, so it'll be interesting to follow through.
Well, I think it's important, Michael, as you suggest, to understand that we have sub-markets in all our capital cities. And one of the aspects of the current issues with the Melbourne market is that Melbourne, of course, as we discussed, has remarkably low auction numbers at the moment. 35% of properties typically go under the hammer in Melbourne, which is clearly the highest proportion of any of the capital city market. Auction marketing typically favours higher priced properties in inner suburban regions because there is more competition for property there. Therefore, the auction is the way to go. Theoretically, because you get competition for property, which pushes up prices in a free market environment such as an auction. However, as we noted, auction numbers are virtually zero at the moment in Melbourne. And that means there will be fewer properties in that mid to higher price range bracket being sold. They also tend to be more discretionary sellers, Michael, anyway. So when we measure the median, we will have a lower proportion of higher priced properties. So that'll, of course, look like prices have fallen. But what's happened, of course, is that the price models are skewed towards the declines in the higher priced section. And the offset to that, Michael, is that we're certainly still seeing, which we'll discuss next time, lending to first home buyers continuing to be strong. And that means there are more properties being sold at the lower end of the spectrum. So, look, we need to take those things into consideration when we are talking about median prices overall. And it does need to be refined by the type of properties that are being sold and the price ranges that they are being sold in. But at the moment, that's one of the factors which will act to have Melbourne's median price being lower, not accounting for those differentiations in the submarkets.
So the bottom line is, despite the median price being one of the most frequently quoted property statistics, it really doesn't mean that's the difference in the price on your home or my home. It actually is more important to understand where your home fits in the spectrum of the various properties. One of the other things that happened this week is the Reserve Bank came out with its normal statement that it does a couple of weeks after its regular monthly meetings. What did you glean from that this month, Andrew?
Well, the Reserve Bank is certainly acknowledging that fiscal policy is the main lever going forward in terms of recovering the economy. It did mention that it thinks the next phase will be very much a state government fiscal stimulus. And when you look at the capacity in terms of public resources, that the states in combination have more capacity than the Commonwealth to stimulate, and they're in a reasonably good position in terms of their balance sheets to borrow, to be able to stimulate their local economy. So they're looking to the states to take up the mantle going forward in terms of fiscal policy, and they're quite happy with the capacity of the states to do that, and also in terms of their debt position. They also mentioned some concerns, Michael, over the higher dollar. They would like to see the dollar a little lower. But of course, there's no secret that our dollar is rising on the back of higher iron ore prices and also on the back of increased demand from China for our iron ore. And that's really a good thing in terms of our current account position and helps us, of course, with our fiscal policy initiatives at the moment. The Reserve Bank was also noting that it's going to continue to provide its extended credit position that it announced in March for the banks. The banks were given a $57 billion facility on the condition they lent it out to small businesses, and that facility was at 0.25% interest, and that facility is being extended, and the Reserve Bank is continuing to purchase government bonds to keep those yields down at 0.25%. Again, that works its way into cheaper lending rates for business. So a bit of the same old, same old. There's no doubt the Reserve Bank is being quite positive about what it can do in the absence of being able to cut rates. But it did say quite specifically, Michael, there would be no increase in interest rates until that 2 to 3% inflation target was starting to look realistic again. And also, they're mainly now focusing on getting back to full employment. So that will be a number of years in prospect, Michael, particularly in terms of full employment.
Interesting how the world turns. A couple of years ago, there were people worrying about the rising interest rates and what it would do to our property markets. People are always looking for reasons for the property markets not just to behave like they always have, to be resilient, to give us a home, to give us shelter. They blame the ugly, greedy investors. But remember, the property markets are being underpinned by the fact that you and I and most people in Australia live in their homes. They don't treat it as speculation.
Yes.
And that's one of the reasons that it's just behaving as it should.
Yeah, well, that's right, Michael, but it's a cheap headline. We know that house price crash. It'll be back again, I guess, when the next outside event occurs. But that outside event will not be higher interest rates, so which has been clearly the driver of lower house prices in the past. So that's one acknowledgement that we are in this new game. We really have been in this new low interest rate game for a number of years, but of course, coronavirus has made a complete reality, and over the longer term as well, particularly the Reserve Bank saying its focus is now on full employment. And of course, the US Fed came out and said the same thing last week, that it's now about targeting full employment rather than the inflation rate.
We'll be back next week. And next week, Andrew, I'd like to have a bit of a chat about finance, because there have been some finance figures that have come out. There's been some commentary about what's happening with the deferred loans. So look forward to chatting with you next week about that.
Thanks very much, Michael.